This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So Warren Buffett has always said he likes to buy stocks with moats. And we haven't really talked about moats much on the podcast, if at all. So I thought I'd take a look at what a moat is. How do you find stocks that have it? It's kind of one of those things, though, where you know it when you see it kind of a scenario. But I'm going to give some examples of the moat stocks on today's episode. Some of these aren't cheap, some are, but it's hard. It's hard to find cheap stocks with moats, and you'll understand why when you get to the end of this episode. So what is a moat? Why would you want that if you're an investor? So a moat is what the word entails. So I always think of, a castle over in the UK. It's got the moat out front. That's the water that goes around. You got the drawbridge that goes over. And when the invaders come, you pull up your bridge, you put down you lock yourself in there in the doors behind the walls, and that moat is supposed to provide you some protection. At least they can't cross it easily, and that gives you some kind of advantage when you're being attacked. So it's a similar thing in investing with moats. So the first kind of key component is that if you do have a moat in your business, then you have some kind of competitive advantage that the others cannot overcome. Something is giving you protection, like the moat at the castle does, but it's happening for your business. So you have some kind of advantage, and it's giving you, it's giving you key upside there. But it can be a number of things for moats that sometimes people don't think about, either on the competitive advantage side. It could literally be the location that the company is in. Competitive advantage, a moat type of scenario could be just being in Silicon Valley for whatever, if you're in the tech side, and having access to VC funding and all the talent that's out there, and experience, and certain lawyers who know how to handle technology companies. Things like that can give you a competitive advantage, at least briefly. And so you got to look at a lot of different things with the competitive advantage side. Another type of moat is a first in type of scenario. And that would be, Apple rolling out the first smartphone. Well, that's going to give them a moat, at least for a while. So the first in isn't as good of a moat as having, an aging moat would be. But you get the moat for at least a little while. And one of the good examples of the first in, like I said, is Apple, because the smartphone, the iPhone came out in 2007. It's still, even up until maybe even just this year, 2024, was giving them that moat. And that was a huge competitive advantage. Other companies went out and created their own smartphones, as we know. But it was really, the first in advantage and other things that made the iPhone what it is. And they've kept that advantage up until even right now. So first in can be a big thing. Another way to get a moat is that you're in an industry where the costs are just so prohibitive for others to enter and try to challenge you. And a good example of that would be Amazon now, with its build out of its distribution centers across the United States and really the globe. Amazon gave it a huge moat, because how many other companies can afford to build out that type of distribution network, especially globally, but even within one country? There's a couple that might be able to do it. Walmart, they may be able to do it. That's the only one that's coming to mind off the top of my head. And you can see Amazon getting that moat in certain countries like India, where a number of years ago, I want to say this was almost like 10 years ago now, they announced they were going to spend $5 billion to go into India, basically, and try to establish themselves there. A lot of people mocked it and said, oh, good luck, because it has historically been very difficult for outside companies to kind of dominate or even get into that market, really, which was dominated by like mom and pop retailers and local shops. But Amazon has stuck it out, and now they are kind of the last man standing over there as far as the foreign companies going in on the marketplace, delivery side of things. And that has paid off for Amazon. And they have what I would consider to be somewhat of a moat there. Now, some moats you may get from government action, basically. So in the US, there's seemingly some drive by Congress to possibly ban TikTok, one of the social media sites, and that may go away. Well, India has already banned TikTok. They did it a couple of years ago. So where did all the people who were using TikTok or who were TikTok creators end up going? They went to one of the other companies like YouTube. YouTube is now huge in India, and some of that was not from their own doing. They didn't create a moat on their own, but they got government or, regulatory help to create that moat over there, and it's working out for them too. So sometimes you can just get so huge, you get a moat just from that. You might have some antitrust issues, at least in the United States, that come up for monopoly if you get big enough and your moat is, wide enough, basically. Another company that Warren Buffett has always liked a lot in this industry because it does have a moat are the food industry with like candy. And so he has been an investor in Mars, and they bought out Wrigley, which is famous for its gum for many decades and still is. And basically, it costs a lot to build a factory to make gum. And so many competitors, once they achieved some dominance, once Wrigley got in there and got its brand out, a lot of competitors just kind of threw in the towel with the costs of all that. So costs can contribute to, creating the moat-like environment. Another way you can get it in a company is, like I just mentioned, from size and from buying out your competitors. You may be the last man standing. And one of the companies that is a symbol of that is Sherwin-Williams on the paint side. They're one of the few biggies. There's only a couple biggies now that they own, like all the brands. And you are starting maybe to see some little bit of monopoly issues, antitrust issues, if they were to try to merge any further. But basically, you get everyone else throws in the towel. They get acquired by the bigger players, and then just sheer size gives you the moat. We've seen that a little bit in the auto industry as well. There used to be hundreds of auto companies, not even 80 years ago, but most of them obviously have gone away, and the winners have created somewhat of a moat, but not a big enough moat that others haven't been able to enter in, as we've seen with Tesla and Rivian both entering in, so that people can keep trying on the auto side, some with success, some with not. So again, how do you find these companies with moats? I feel like Warren Buffett just kind of runs across them in his research, and using various brands, you get an idea of who is basically the tops in an industry and who has the type of business where no one else can enter in there. And basically the kind of thing where, everybody uses that item, or, eats at that place, or stays at that hotel brand or whatever it is that, they might be able to build a moat around. But remember, moats are somewhat unusual because it does mean you have triumphed, but it also means you do have a business with some kind of competitive advantage. So, like the example I just said on the hotel side, those can get really big. You could be Marriott with their thousands of rooms now that they have, but that doesn't necessarily mean it has a moat, right? As we saw, because Airbnb entered the scene and started taking business away from them. So there was not the moat you might think, even though they're big and they might dominate some markets with their hotels in certain cities and whatnot. But there clearly isn't as much of a moat in a business like that. So you want the ones that do have it. And some of them, again, you're just going to have to know when you run across it. Everybody knew Apple had a moat with the iPhone, right? And it still kind of does. But it has entered other businesses like streaming, which seemingly doesn't really have much of a moat. So some of us thought it might because Netflix was spending so much money on its streaming content, but it turns out just about everybody can have a streaming service these days. They're not all going to survive and triumph, but you can have them. And so that's not really giving you that much of a competitive advantage. The thing that Netflix really got a competitive advantage of was its DVDs, the little red envelopes. That was much more of a moat than anything else. The quick delivery, the fact that you could get 2 or 3 and keep them at home, and then just you mail it back in and you get whatever one you want back. Now, then we had the red box that kind of came onto the scene to compete with that, but it did take a number of years before the red box entered the scene. And in that time period, Netflix really did have the first in type of moat where they dominate for a number of years, but then it ultimately does go away as competitors enter the scene. And then they got rid of it altogether. And then they had the first in with the streaming too. So Netflix has had several moats, but what's their moat going forward now? Is there going to be something past the streaming, or will they just get a moat because they're the biggest and they attract the most talent and therefore the most viewers and subscribers in the end? They'll defeat the others or they'll buy out the others. I don't know. We're still waiting to kind of see with a moat on Netflix, the next moat that they're going to have. So I'm not feeling the moatiness that much with Netflix right now as I am with some others. So NVIDIA right now has a moat to some extent on its AI chips, right? Because there are others that have AI chips, but NVIDIA right now has the first in advantage, and it's using that to its biggest capabilities to get the competitive advantage and have a moat. It's got the drawbridge drawn up, and if you want those chips now, you have to go to them. But that will change. We already have seen it, and it's going to be more competition as it goes along here. So NVIDIA's moat, its kind of first in moat, is going to fade pretty quickly. It's not that cheap right now on just a PE basis at 37 times, but I do feel like that's pretty cheap on a historic basis for NVIDIA. And if something were to happen in one of its upcoming earnings reports where maybe guidance was a little lighter than the street is expecting, and it's going to happen at some point, that it will guide not so great. When that happens, the stock will likely sell off further than it already has, weakened a little bit here. It's not been terrible by any means, but maybe we get a bigger pullback over 10%. And then this stock is going to be looking, even more attractive and much more like a value. I'm not saying it's going to go under 20 times, but occasionally these Mag 7 stocks have gone under 20 times, which is pretty cheap as long as they've got the growth still going on. So keep that in mind when you're looking for cheap stocks with moats. I'm sure Warren Buffett would love to see NVIDIA come down like that much where it's trading closer to 20 times. But this is also why I did that episode of the podcast just a couple of weeks ago about why Warren Buffett may perhaps buy Alphabet for Berkshire Hathaway. And that's when it was trading at 22 times. It hasn't gotten cheaper than that, really. It has rallied a bit and was hitting new highs again. But we're waiting on the earnings. So you never know what might happen on an earnings report. But Alphabet also has moats in several of its businesses, including advertising. But now that might be challenged by AI, but we'll see. So Alphabet's still trading at about 22.8 times. That's still really cheap, even though it has rallied and is, hitting new 52-week highs here at least. So, the moat is always changing. You got to keep an eye on it. But if Buffett ever considers Alphabet, then on a pullback, he may be wise to consider NVIDIA as well. He has lamented over the years, by the way, that he never got into like Amazon, like way back in the day, like when it went down, real cheap in the .com bust and all that. He never got into it. Berkshire does own some Amazon shares, but it is owned by one of the lieutenants. They did sell off a little bit of it recently, but they've never really gone all in on it either. They just kind of bought a position and then have stuck with that. So we'll see. We'll see what happens with some of these techie names in the Berkshire portfolio. Another stock that I feel like investors who are looking for moats, but real cheapness, a stock they should consider is United Rentals, ticker URI. We've talked about it in the past, but it's been a while because it's been on this amazing run. So they're the largest equipment rental company in, I think, the world now. It used to just be North America, but that was a number of years ago. And I think they made some acquisitions now where they actually are not just US and Canada, but they're in several other places. They grow through acquisitions. So, buying out other companies is not unusual for them, but that's a sign of their moat that they are that big. And I guess, can we say any company that's like the world's largest might have some kind of moat? I would think that they would, right? But rental equipment, these are like not the small pieces of equipment that you and I might use. These are like construction equipment that you would find on a construction site with someone building a big building or a bridge or something like that. Also in certain industries like energy and things, they have rental equipment for that. So it's very expensive to acquire all that equipment in order to rent it out. So that is a barrier to entry right there. No one else really wants to get into this business, but there are competitors. There's H&E. Wait, let me see. H&E Equipment Services is their real name. HEES is the ticker with that one. So they don't have a complete monopoly. There is a smaller player. They only have 2.2 billion market cap, but United Rentals right now is trading at 15 times, a PE of 15, and H&E Equipment is trading at 12 times. So a little bit even cheaper there with a PEG ratio of just 0.8. So they've got growth and value because right now there's a lot of construction and building going on. We have the $1 trillion infrastructure plan. And so that money is being dispersed and it is going into these areas that is helpful to both United Rentals and H&E Equipment Services. So both of them are, moat-like, just in a little bit different ways, but URI is definitely the bigger player with the bigger reach and the bigger moat, but a little bit more expensive for URI. It's been on the tear, so we're waiting for earnings, which are coming on April 24th for URI. So that's a couple of cheap moat stocks. and they're both old economy. Let's call it what it is, right? If you're renting that big piece of equipment, as much tech as might be on it, it's still the old economy. You're going out there to construct something that's been going on throughout all of time, right? But that's where you sometimes find these moat-like companies in the old economy, because these are the winners. Another area I've always liked where I felt like you can find moats is in uniforms. So I've always tracked CTAS, which is ticker CTAS, but it has not been cheap for years now, unfortunately. Even though I still keep tracking it, and on pullbacks, I'm like, oh, maybe I'll get it cheaper now, but I never do. It has a forward P of 44.7. And if you are in a major city and you are near where businesses are that use uniforms, you will without a doubt see a CTAS truck like driving around. It happens all the time. We've gotten so used to it, we don't even notice anymore. Kind of like when you see the Amazon van, you don't really think about it. That's true of CTAS too, but they just provide so many uniforms to so many businesses. Market cap of 67 billion. But again, trading at 44 times, I just can't justify, even with having a nice moat. There are other uniform companies, but they're the biggest, and they really do use their size to create a competitive advantage there. Shares are a little bit off of their recent highs, but not enough, because they just keep going and going and going. And so they have been trading near their all-time highs just again recently. So kudos to all those who realize that uniforms are important and this company has a moat, and who bought in several years ago, or even on the sell-off during the start of the pandemic, because the shares are up huge. Let me see. They basically tripled, or more than that, quadrupled, since the bottom lows of the pandemic. So kudos to them. And they continue to grow earnings, but it's just too pricey for me. But these are ones, when you're looking for moat stocks, that you should keep on a short list, a moat list, as I would call it, so that if there is some kind of event like the pandemic sell-off, then maybe you can get in at a cheap enough level for your value investing needs to really get in there and jump in when you see these kind of sell-offs. Another area it's been in the news a lot lately is airlines, airline manufacturers like Boeing. Boeing obviously has a moat. I mean, who else is there? There's Airbus, there's Embraer down in Brazil. And is that it? I think that might be about it. There's a few others, I guess, out there, but really they just have the moat. Some of it is from government, on the government side, government advantages through regulatory changes over the years. Some of it's through mergers. And so now Boeing, the premier and really the only U.S. airline manufacturer, but it's not cheap, because those estimates keep getting cut, and the shares, while depressed, are not depressed enough, really. Boeing with a PE of 465 right now. It is a Zacks number 5 strong sell, because those estimates are being cut on all the continuing issues that are going on over there. So those looking for moats have had a winner in Boeing for many years, up until the pandemic, really, and then not so much. So that's an area you can find the moats. And another area is in energy, and not so much with the producing side, but with refining. So if you've ever driven by a refinery, maybe you have and you haven't really known what it is, but they're kind of unmistakable when you see them, because they are massive structures, and refining costs a lot of money. it can cost, anywhere, well, it's billions to build a new refinery. We haven't built a new one in the United States in many decades. And so now I think the going rate, if we were to build one, is at least 5 billion, right? 5 to 10 billion would be my estimate nowadays. And so they aren't building them. So there is a barrier to entry there, on the cost side, and also somewhat on the regulatory side, because a lot of communities don't want a refinery in their community. So you have to deal with all of that. So there's all these issues out there. So the refineries that do exist right now have the competitive advantage because there's all these barriers to entry for any new competitors. So there has been a lot of consolidation over the years, though, and some of the refining companies have bought out the others, and that's how they've grown and added. But there's still a moat there with the remaining players, and one of those is Valero Energy, ticker VLO. It has a forward P right now of 9.8, so it is a value. It has been trading near 5-year highs. The earnings estimates actually, though, have come down quite a bit for 2024 versus 2023 because refining margins are due to the crack spread. And so if you're going to buy the refiners, you kind of have to realize how they make their money and what market conditions really increase those earnings. But they definitely have a moat because no one else wants to go out and buy the stuff and build one of these huge complexes. So keep that in mind when you're thinking about energy. There still is some moatiness with the producers. Certainly the bigger you get on that end of things, the more advantages you have. But there have been new oil companies, at least in the United States, starting up throughout the years. There's always some executives at some of the bigger companies who just think like, I don't like how they're doing stuff here. I think I can do this better. I'm going to start my own company and I'm going to drill in these other places. And some of them have grown those into still small energy companies, but they're out there in the game and they have managed to get in the game. So there is not as much barrier to entry as you might think, even though you have to put the rig in and get the oil out of the ground. That's not cheap, but there are banks and others who are willing to lend to allow new competitors to get into that area. So not as much moatiness as you might think, but the big guys, the Exxons and the Chevrons, have some of the competitive advantage just by their sheer size and their capabilities. And as I mentioned earlier about location and even being in places where they're able to get talent that others cannot get, that creates somewhat of a moat. And those big energy companies are able to do that to attract the real good petroleum engineers and things like that. So there's that area. Another area that has some moatiness in it, but not completely, is the home builders, actually. And that's been cheap for a while, but we've seen a lot of consolidation in the industry after the housing bubble 15, 16 years ago and the bust. Some home builders went under, others were just bought up. So there's fewer publicly traded home builders now than there used to be, and they're bigger and they're more dominant. Now, some of that has given them some competitive advantage, but there's still not as big of a moat there as you might think either. And they're still competing against existing homes and less against each other in some respects. But you can find cheapness there, and some of them do dominate certain markets. And when money gets tight, as we've seen it now, the lending from banks and whatnot, these bigger home builders have the capabilities to withstand some of those pressures more than the smaller. So they have some moatiness, but not as big a moat as, say, a Wrigley does, or even Amazon now with its distribution centers. But one home builder to keep on your watch list maybe is KB Home, ticker KBH. They are pretty dominant in the West Coast because they're based in Los Angeles. They're cheap. They already reported earnings. It was another good quarter. They have plenty of free cash flow. They're buying back shares plus a dividend. PE is just 7.7, but they are going to be mortgage rate sensitive. And when those mortgage rates go up, and if they were to go back up to 8, then things are going to slow quite a bit on the sales side. Plus, they've been buying down mortgage rates. All these home builders have, and it costs them more. The higher up it goes, if you want to get it back down to 5.5 or 5.75, you got to pay more money to get it down that far for the buyers. And so that's going to go into their margins as well. We have been over 8 already during the cycle, and that did slow everything, but we didn't really stay above there long enough. It just meant some buyers stayed on the sidelines and waited for it to come back down. So that could happen again, but if we are to stay above 7, even for a lot longer time period than everyone was expecting, we don't get rate cuts and the 10-year treasury remains elevated, then the stocks could see a little bit of earnings pressure, and the shares probably will come down off of those highs. They already have in the recent sessions here, but home builders are an area you might want to keep an eye on as well. Another one I've already mentioned with Amazon is on the retail side. You do tend to get some companies with moats in that area, but I don't like those moats as much as like a pure tech moat or we're so big we defeated everyone, and we have an item like gasoline that everyone still needs for now, at least, and no one else can make that gasoline. Because with retail, you occasionally get like a hot retailer with a product, kind of like the iPhone, even with a product that everybody has to have, but they only have to have it for a while. And eventually that moat does fade away. Now, retail can be good for moats if you can get it like early on in their moatiness. And then you can hold on through that. So I'm thinking of like West Elm, for instance. That was one of the hottest furniture retailers for the last 10 years. Double-digit sales, same store sales growth seemingly every quarter for years. And I don't know how they did it still. But the West Elm, that mid-century modern structure, just became so popular that everybody had to have it, and they were one of the few at the right price point. So everything fell into place and they managed to have it. But do they still have it? That's the question. It's been about a decade, and any kind of moat like that in retail tends to fade eventually. Everybody knows this. So that's when it can get a little dicey. But if you manage to get into that trend 10 years ago into the West Elm stock, which is Williams and Sonoma. That's who owns it, and they've owned it the entire time. So people always think of them just owning maybe Pottery Barn or just that they're only Williams and Sonoma. They're not. They have, several brands that everybody loves, but West Elm was really the driver for them for a number of years. And I'm taking a look, just kind of going back a little bit to see 10 years back. So that'd be 2014. Yeah, so it was trading around, let's see, let's get it to April 2014. Maybe around $70, 70, 75, somewhere in there, 60 to 70. And now it is at new all-time highs above $300 right now. So shares have been surging recently. So not too bad if you got in at the bottom of that trend and you've been riding it all this time. But for that reason, I'm not as big a fan on the retailers. You have to really get one that has the huge moat due to its size, like a Walmart, like an Amazon, or even a Costco, where there really isn't that much other competition there except themselves, really. Okay, so that's covering a lot of moats on this episode. Not all of them are cheap. As I mentioned, several of them are still just too pricey for me to buy, but the moats are pretty obvious when you stop to think about it. So it's about timing. It's about getting something that's out of favor, like United Rentals has been for a number of years, and then buying in and getting that moat advantage. So let me recap the stock tickers I talked about. So I did talk about Amazon, so we'll mention that. AMZN, Netflix, NFLX. I did mention NVDA. It's got a moat for now, the first in moat. NVDA, United Rentals, one of the cheap ones. URI, H&E Equipment is also in the same area. Equipment Rentals, HEES. H is in Harry, E is in Edward, E is in Edward, S is in Sam. Then I mentioned Sherwin-Williams on the paint side. As many of you know, I've been waiting forever for that to get cheaper. It's still at 27 times, but it's S is in Sam, HW, SHW, CTAS, the uniforms, CTAS is the ticker there. Boeing is BA, and then Valero, the refiner, is V as in Victor, L as in Larry, O, VLO. And as always, you want to be sure to subscribe so you don't miss a single episode, because we're trying to find these value stocks and there's more coming at you. So be sure to get us on Apple Podcasts. We're on YouTube. Just put in Zach's Podcasts and get us on YouTube. You can also find us on Spotify. We're also on Amazon Music and any other platform. For the most part, you can find podcasts, you can get us, but be sure to subscribe, and I'll see you again next time on The Value Investor.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.